In this video, I'm going to touch on trading psychology and risk management strategies. Now, this is an area of trading that, quite frankly, takes up its own course most of the time, or even books. There's huge volumes of books written about this one subject. And that's because one thing that I would point out, and it took me a long time to learn this, that, anybody can learn to read a chart. The question is, can you hang on to the trade? Can you recognize when it's time to get involved? And can you accept losses? There are a lot of different things out there that you need to pay attention to when you get involved in a trade. So, for example, I've got Goldman Sachs in front of you, and you can see we formed a bearish candle right here at previous resistance, and you sell, and that's fine. I could teach anybody to do that. That's not the hard part. The question is, are you comfortable as it's going against you? Do you accept the fact that not every trade is going to work out for you? An analogy that I would use is that a lot of you have retirement accounts out there, and the retirement account, let's just say it brings back just 10% a year. That's probably pretty decent, steady returns in a retirement account. Some years it'll be 5%, some years it'll be 15, whatever. But, if you average 10%, you're relatively happy with that trading activity. So the question then is, do you micromanage every trade that the fund manager takes? Well, of course not. You're not going through and saying, okay, well, you lost 2% here, you lost 1.1% here, you gained 2.6, that's great, and you gained 1.1, but, what are you doing losing 0.5% here on this trade for, whatever the trade was? No, you look at the total returns. And that's something that you have to focus on. You can't focus on any one trade. That's the hardest thing for some people to do because you get very emotional. But you have to understand that sometimes things just happen. You can have the best technical analysis in the world, and you can have what looks to be a sure thing just blow up in your face because of some random comment from a central banker, or a scandal in a company, or a multitude of other, a hurricane, an earthquake, whatever. So one of the best ways to look at this and to take advantage of the markets, but also make it so that you can stay in the market, is have a risk management strategy. And in my case, I only risk 1% on any particular trade. So, and that's 1% of the total portfolio. So just to keep things simple, let's say it's $100 in my little, portfolio. And I risk 1% and I lose, and that puts me at $99. And I risk 1% there, and I lose again, and that puts me, instead of 98 this time, it's 98.1. And then I risk 1%, and my 1% brings me back a little over 98 cents. So I'm back over 99 slightly, and so on. When you get that type of reaction, your equity curve is going to look like this. It's very steady. You can function. The problem that a lot of traders get is they worry too much about the destination and not the journey. So what they'll do is they'll risk 5%. And in the same portfolio, a little $100 portfolio, you lose that 5%, and then you're down to $95. Okay, well, it's not the end of the world, right? So you gain 5% after that. Well, you're no longer talking about $5. It's less. You're actually at 99 and some change. So that's the paradox here. You lose 5%. Now it takes about 6% roughly to get that back, to break even. So it becomes even more difficult because remember, the trade is going to work out one way or the other. And the market doesn't care that you need 6% this time instead of 5%. And the reality is a 5% move might be difficult to get in whatever market condition is. What if it's only 3%? Well, you're kind of on your way back, but you haven't made it. And 3% after 5% loss is roughly halfway. So again, you have that issue. I mean, the reality is that you need to stay in the market. Your number one job is to make sure that you keep your capital in your trading account. You must protect your capital. And the easiest way to do that is to simply risk something that you're comfortable with. And being comfortable is the next point that I would cover. You should be comfortable enough that you can short this candlestick here, for example. You can put your stop loss above it, and you can just let the market do whatever it's going to do. Say you have a target down here, and you see it did work. You know, it was the middle of the next day, but let's just say that was your target. Well, there's no reason to get out of the trade until the stop loss is hit, and you have to be comfortable enough that you can walk away, quite frankly. You don't have to sit at the computer white-knuckling the whole time. Well, let's look at a little bit more common chart maybe for a day trader. You get an extremely bearish candle there that you decide to short, and you recognize that there's probably going to be support there, so you just try to pick up, say, 50 cents. You put your stop on top of that candle, because if we break above there, that would negate that signal, and you hit it. But are you going to sit here and white-knuckle it for 30 minutes? Or are you just going to let the market do what it's going to do? Because it did move up a little bit against you. You know, are you going to freak out? The first couple ticks you get against you, oh my God, I'm going to lose money. This is why, and this is another thing that helps with the risk management, this is why you will hear me more than once through the course talk about what's the longer term trend. Trade with the longer term trend. Yes, I realize, and I don't even know what the longer term trend is on this chart. Let's pull up the weekly. Okay, well, it's been a lot of downtrending here recently, so it makes sense that you would be more of a seller, but you are approaching support. During this time, there would be, frequent pullbacks during the day, but, it's not that you can't get that money, but quite frankly, it's just easier to go with the trend. And that will more often than not make the markets a little bit more forgiving of your trading. There is a huge list of things I could be going through, but suffice to say, position sizing, comfort. You have to be psychologically comfortable. You have to realize that this is a marathon, not a sprint. So one loss of 1% isn't going to end your trading career. You don't need to get it back right that second, because if I told you, hey, at the end of the year, you're going to be up 33%, and you knew that was the outcome, then why would you sweat a 1% loss? And that's something that you're going to see a lot of. You're going to have a lot of days. You're going to have days where you have 3 or 4 losses in a row, where you're just on the wrong side of the market and for whatever reason can't get a handle on it. Those are the days you get up and walk away. You just cool off. You give yourself some time away from the screen, and then you can approach the market maybe later in the day or better yet, the next day when things have calmed down. Honestly, anybody can read a chart, but it's what you do with the trade once it's in play that truly matters, and position sizing. I would be willing to say that psychology is probably 85% of trading quite easily. Now, you need to have the tools to read the charts and understand where the market may or may not go, but you have to understand also that, and truly understand this and accept that just because it looks like it's going to struggle to get above 238 on this chart doesn't mean that it can't. So keep that in mind as well. Take a breath, relax. You're in it for the long haul. You're going to learn to enjoy the process. I promise you, if you spend enough time doing this, there's a lot of highs and lows, but at the end of the day, it's a smooth equity curve that will calm your nerves.